a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about ETFs that provide you 100% downside protection. Yes, that's right. So these ETFs will allow you to stay invested in the stock market while protecting you against any losses. So what are these ETFs? So this is a newer category within the broader group of defined outcome or buffer ETFs. These defined outcome or buffer ETFs, they allow investors to participate in the market's upside up to a cap while limiting losses if market falls. And this is one of the fastest growing segments of the ETF market, in particularly during 2022 turmoil when stocks and bonds plunged. These ETFs saw record inflows than last year as well. Currently, there are more than 160 defined outcome ETFs with about 39 billion in assets under management. And this category was started by Innovator ETFs, who launched their first defined outcome ETF in 2018. And since then, the category has been growing very fast. Now, let's talk about these ETFs that provide 100% downside protection. So last year, Innovator had launched the first defined protection ETF that provides 100% downside protection. And last week, Calamos launched the first of 12 of these 100% defined protection ETFs. So in fact, I had talked about these ETFs last year when Innovator launched the first one. So it's a good time to revisit because now we have more ETFs from Calamos. So again, these ETFs will help you participate in the market upside. So that's the trade-off. You participate up to a cap only. And they will provide 100% downside protection. What is important that this protection is over the outcome period. So that defined protection is assured if you buy on the first day of issuance and then hold it over the entire outcome period. If you buy, you can buy after the outcome period has started, but your experience, your outcome may be slightly different from what is defined, and the provider will show you what your outcome will be, is likely to be. So this is the first ETF which launched last year, Innovator Equity Defined Protection ETF. The ticker symbol is TJUL. And so for this, the outcome period is 2 years, was 2 years. And this provides, this seeks to match S&P 500's return with a cap of 16.62% over this outcome period of 2 years. Investors forego dividend income. Expense ratio is 79 basis points, and it has gathered to 27 million in assets very quickly. Let's go to the quote page on Zacks.com. As I mentioned, I had done a video and I had also done a podcast with Innovator. So that's a good one if you want to understand this product and these defined protection products in general. You can listen to that podcast. Using the link, you can go to Innovator's webpage for this ETF and see the current outcome. So you can see that current outcome will be different from the defined outcome. So this is the outcome period, this is the starting cap, and this is the exposure that it is providing. And the expense ratio, as I mentioned, is 79 basis points. And if you want to invest now, Innovator will show you what your potential outcome is going to be. Now, let's take a look at the second ETF. So, as I mentioned, Calamos launched this ETF last week. This has 1 year outcome period, unlike T-Juice 2 years outcome period. So for this, the outcome period is from May 1st to April 30th next year. For this, this seeks to provide S&P 500's return with a cap of 9.81% and 100% downside protection, slightly cheaper, 69 basis points. Expense ratio. Again, if you want to learn more about this ETF, you can go to the quote page on Zacks.com. Using the link, you can go to Calamos web page. This will show you. So this was the starting cap, and it will also show you what is the current outcome. So the current cap is slightly lower, and current protection level is also slightly lower, and these are the remaining days left. Now, Calamos will be launching more ETFs. So as I had mentioned earlier, this is the first of the series of 12 ETFs that they will be launching, and these products that they will be launching, they have these indexes. They will provide exposure to the S&P 500 or the Nasdaq 100 or the Russell 2000 index, and they will continue to roll out these products. So this product just launched. So the next product, which will provide exposure to the Nasdaq 100 index with a cap, will launch on June 3rd. And then the one which will provide exposure to the Russell 2000 index will launch on July 1st. And they will continue to roll out these products, so you can join if you want to be assured of that outcome, the defined outcome. You can buy on one of these days of the launches so that you are assured of the outcome. Now, how do these products work? So what these products do is that they invest in flexible exchange options, or they are also called flex options. And they buy flex options with varying strike prices. So basically the strategy involves buying deep in the money call options that provides you the S&P 500 exposure, and then they will buy at the money put options, which will provide 100% downside protection. And we know there is no free lunch in investing, so you cannot have exposure to the S&P 500 index with 100% downside protection without sacrificing anything. So this is what you trade off is. They will sell call option to limit upside return. So this is how these ETFs work. They're pretty transparent. In fact, if you go on their website, they will show you what they hold, and you will be able to see those flex options, the basket of flex options as their holdings. Now, should you invest in these products? Should you get downside protection? So over the long term, stocks generally go up. Now, they have been going up over the last 1.5 years or so. The stock market has rallied too much, too much. They have come up too much too soon. So many investors are really worried whether this rally can continue, or because we have so many rising risks and a presidential election coming up, risks of a recession, geopolitical risks are there. So many investors are worried. But over the long term, stocks tend to go up. In fact, since its inception in January 1993, SPY ETF which tracks the S&P 500 index, that has an average annualized return of 10.3%. 3%. So by seeking downside protection, you are giving up some potential upside beyond the cap which these ETFs have. So obviously they are not suitable for long-term investors. At the same time, many risk-averse investors, particularly those in or nearing retirement, they have been reluctant to buy stocks lately. And that's why there's so much money in cash on sidelines, so much money sitting in money market funds. So if you have money in money market funds earning 5% return or 4.5% return or even lower return in bank deposits or something, then you can certainly look at these ETFs. You get a better outcome over here. And many of these investors, risk-averse investors, have been investing in fixed index annuities or market-linked CDs that protect against any downside. But those come with much higher fee, carry higher investment minimums. They have longer lockup periods and unfavorable tax treatment. So ETFs like the ones that we discussed today by Innovator or Calabos, they are a much better option for these risks if you are a risk-averse investor. Thanks for watching. Make sure to check out Zacks.com/promo for an interesting offer. Also, make sure to subscribe to our YouTube video channel so that you do not miss anything. And I will see you next week.